Everyone's trying to trade Bitcoin, but most are still losing money. Why? Because most strategies stopped working. Markets have changed. Smart money adapts. But the crowd keeps repeating the same patterns. Yet, there's one approach that keeps quietly outperforming. In this video, I'll show you exactly how it works, with real proof. Welcome to Trading Insights. No hype here, just smart trading logic, sharp tools, and the facts. Remember, nothing in this video is financial advice. This is an educational breakdown based on actual market behavior and proven results. If you're serious about improving your trading, let's get right into it. Let's be real for a second. Most people are using the same old playbook. Patterns, oscillators, scalp methods. They're stuck on the 5-minute chart, chasing every blip, every wick, hoping for quick wins. But the game has changed. In 2025, bots dominate low time frames. Algorithms trade against each other at lightning speed, creating fragmented volume and endless fakeouts. If you're still scalping, you're probably trading against computers, not people. That means more whipsaws, more stop hunts, and more frustration. Retail traders get wrecked chasing price on tiny time frames. It's not about intelligence or effort, it's about structure. The market's evolved. So what still works? What actually performs even now? The answer, trend following on higher time frames with macro-level confirmation. Let's break that down. On the daily and 4-hour charts, you filter out the noise. Sudden moves, random spikes, bot-driven shakeouts, they fade into the background. What stands out are the patterns that matter, the footprints of institutional players and whales. These big players don't care about tiny moves. They build positions over days or even weeks. Their entries and exits leave clear tracks. Key price zones, real support and resistance, hold up far better when you zoom out. So instead of reacting to every tick, you wait. You study the chart for high-conviction breakouts. What does that mean? It means waiting for price to consolidate, ideally near a major resistance or support level. Then, you watch for a real catalyst, a spike in volume, a moving average crossover, a surge in ETF inflows, or a headline that matters. When all these align, you get a breakout that isn't just a random move, it's a shift in structure. Let's look at a real example, so you see how this plays out in practice. Back in March 2025, Bitcoin spent 2 weeks consolidating just below $78,000. Price chopped sideways. The impatient got chopped up. But then, volume surged. ETF inflows hit a record. The 50-day moving average crossed above the 200-day, a classic bullish signal. And then, with a clean daily candle close, Bitcoin broke out above $78,000. Traders who waited, who didn't chase every candle, entered above the range, with stops set just under the consolidation. Over the next week, Bitcoin ran hard, over a 2x return, with less stress, less noise, and no frantic scalping. No guesswork, just structure, patience, and confirmation. So how do you put this into action? Here's the formula. Clean, simple, repeatable. Step 1. Identify the macro trend. Use the daily or 4-hour chart and anchor your analysis with the 50 and 200 moving averages. Are they sloping up or down? Are you above or below them? That's your directional bias. Step 2. Wait for consolidation near a key level. Don't force a trade. Let price base out near resistance or support. The longer the base, the bigger the potential move. Step 3. Watch for volume and news catalysts. This could be a sudden volume spike, an ETF inflow report, or major policy news. You want confirmation from the real world, not just a chart. Step 4. Confirm the breakout with a candle close, not just a wick. This filters out fake moves. Step 5. Set your stop just below the range low. Don't overthink it. You're trading the structure, not your emotions. Target 2 to 3 times your risk. Let the move play out. Bonus tip. Check the funding rate, the fear and greed index, and Bitcoin dominance. If funding flips positive and the crowd gets greedy, be cautious. If dominance rises alongside price, it's usually a stronger move. Why does this strategy work even now? Because it aligns with how the professionals trade. Institutions don't scalp. They build positions slowly, waiting for the market to tip its hand. When the breakout comes, they push volume in a coordinated way. It's not subtle. It's a statement. You want to ride with them, not against them. This approach takes patience and discipline, but it's repeatable, it's logical, and it's backed by real market behavior, not just theory. If you learned something new or this helped shift your mindset, subscribe to Trading Insights. No empty signals, no hype, just strategy that evolves with the market. Drop a comment. Are you still trading short time frames, or are you making the switch to macro setups? Let's talk about what's working for you. Stay smart, trade with intention, and remember, this is not financial advice. It's about understanding the game and playing it with clarity.